Hi guys, welcome back. This morning the SGX Nifty is indicating that the start will be well in the green, but let's see which way things go. For now, actually it's at the high point. 11,000 is a level that we could perhaps scale. But the stock of the day, the stock of yesterday was Jubilant Foodworks. Bizarre move seen, in just a matter of 4 hours. The company completely backtracked on that royalty issue. Prashant Nair joins in on the phone line. Prashant, good morning. First of all, congratulations on that big break yesterday. But it was pretty frenetic, the pace at which the company backtracked on their decision.
First of all, no, absolutely. I mean, at around 6 o'clock, the company informing exchanges that they are essentially going to be paying a royalty of 0.25% to promoters, and around 10 o'clock, a little after 10 o'clock, another exchange release essentially saying that the promoters have decided not to collect the royalty. I mean, so I think what happened in those last 4 or 5 hours, the 4 or 5 hour gap, which essentially led to the reversal. And what I understand from various investors I've spoken to is that lots of big institutional investors got in touch, spoke to them, wrote in, and essentially expressed their deep displeasure at the way this was being done. Remember, and I highlighted this yesterday, this proposal technically does not need SEBI's, it does not meet the requirement for getting a shareholder approval because it doesn't meet the material threshold. So this would have gone through if the promoter had persisted. So, and that is the reason why investors got in touch and said, well, this is not done. If you want to you want more money out of the business that you're running and running successfully, pay yourself a higher dividend, increase the dividend payout ratio. But this will not go down well. This will harm the reputation and it will set a very bad precedent. And of course, I mean, we all saw the big backlash on social media, retail investors expressing and venting their frustration. And I think all of that went into that decision, finally reversing this entire transaction, which came through. I think, this morning we will see a reversal of the damage. I mean, some of the damage at least that we saw yesterday on the stock. And I think, the business is a strong business. The franchise, it's in the right sector. It's a strong franchise. It's one of a kind in that sense, at least here in the Indian market. So maybe there will be interest which will come back. But I don't think, while the market may forgive and move on, but it will have this, it will not forget completely this episode, which of course has kind of, soured the sentiment as far as investors.
Oh yes, Prashant, that point is taken. The stock will reverse the losses for sure. Some of the losses, some good sense prevailed, but will not get the peak valuation. Let's put it that way.
But they have actually sent to the exchange the order saying that they will take the dividend after watching the way the market reacted. So it was not, they were okay with losing about 6% of the share, but probably when investors told them that it's not 6%, it's the start, and you're going to lose a lot more. It's only then they panicked. So it's clear that they were ready to take on. Okay, if there is a loss, you're sending it to the exchange.
End of the day, market cap loss is notional. What you get in hand is real. So, but anyway, I think you'll still want to give some credit to the management for listening. They could have gone ahead, but at least they listened, and I think that's good news. By the way, also keep in mind, even in Jubilant, some part of the equity is pledged. But anyway, let's move on. Now, Tech Mahindra looked like a good set of numbers, but it came right at the end, around 326. Rima, we should expect some more green?
Yes, I think so, Anuj. This is an all-round beat by Tech Mahindra. So on the top line, the company's delivered a constant currency revenue growth of 4.3%. Peg it compared to the peers, and you'll see it's better than what Infi, TCS, as well as Wipro delivered this quarter. The margins have expanded by 75 basis points sequentially, and in the last 2 years, the company's managed to improve their EBIT margins from sub 9% to now 16.1%. The internals are looking good, so the telecom growth story continues. The deal wins are strong at $440 million. Brokerages are happy. CLSA ups the target price to 810. Kotak says that going ahead, revenue growth normalization and 5G are further catalysts, and plus the stock is inexpensive at 13.5 times F520 PE. Back to you.
Thanks a lot for that. So doing the best in the entire peer group, except HCL Tech, of course, they did 5.6%, but Tech Mahindra's constant currency growth at 4.3%, looking pretty impressive. Let's go across to Sonal now. She'll tell us about HPCL and how the numbers look this time around. Hi, Sonal. Morning.
Hi, good morning, Sonia. Well, the numbers did not look as bad as the street was estimating. The core refining performance, that was good this time around. The core gross refining margins, they came at $10 per barrel. That compares with $2.9 per barrel barrel sequentially, and it was the inventory loss that led to lower reported GRMs. Inventory losses came in at $6.3 per barrel, and reported GRMs thereby came in at $3.47 per barrel. On the marketing side, there was a slight weakness, though the marketing volumes were up 7% sequentially and 3% on a year-on-year basis. The gross marketing margins, they were flat on a YY basis, and they declined sequentially. So that place is something where we saw some weakness. However, Citi says that investor interest could stay muted till general elections. They have a buy rating with a target price of 285 rupees per share. Back to you.
Okay, thanks a lot for that. Anisha, you have a bunch of earnings on your radar.
Oh, well, yes, Tata. I'll start with a bit of a shocker, and that is from Blue Star because they reported a loss on the bottom line. Yes, there's an exceptional expense of around 7 crores and a one-time loss that they have taken of around 7 crores. Nonetheless, the cooling products margin has halved to 2.3% now. The management says that the outlook is positive and they'll work around to improve the profitability, but that is a big disappointment coming in from the company. Moving on to Torrent Power, where the numbers are pretty much in line with expectations. The top line has seen a steady growth of 18%, but the margins depleted by 600 basis points. The profit is, however, decent because there's a tax write-back that they have adjusted for. Moving on to Hindalco, that will be in focus because Novelis reported an inline set of numbers. The EBITDA is up around 5.6%, and even if you look at the EBITDA per ton, that has gone up by 5% to come in $403 per ton. So that should be a positive development there. And lastly, for Tata Chemicals, it's not a very good set of numbers because there's weakness across the segments. The margins have come off, and even if you look at the operating margins, down to 16% versus 20% last quarter.
Okay, thanks for that. Okay, quite a few numbers in the red. Sonal, you have a bunch of real estate stocks.
Yes, absolutely. I'll start with DLF, where the bookings this quarter were at around 583 crore rupees. That implies a decline of 10% sequentially. However, they grew by 17% on a YY basis. The management says that they are on track to exceed their guidance of bookings of around 2,250 crore rupees. And they also say that DLF X of DCCDL continues to target net debt zero by end of FY20. So that is some positive commentary coming in from the management. Going on to Brigade Enterprises, very good operational performance by the company this time around. The sales volumes were up 68% on a YY basis. The sales volumes also increased by around, sales value also increased by 70% on a YY basis. The stock should see some green. Soba, on the other hand, had already reported the operational performance that was a little weak. However, the collections have improved by 21% on a YY basis. The net debt has increased slightly by 340 crore rupees. So let's see how the stock reacts to these numbers.
All right, Sonal, thanks a lot for that. Mangalam, what about other results?
Well, I have a whole host of them on my plate, Anuj. We start with V-Mart. Smart revenue growth of close to around 27% led in the festive season, but that did not percolate to the bottom line, which resulted in just a 13.6% growth because the company is investing in employees as well as operating expenses. They're adding a few warehouses, so which is why the margins came off by 140 basis points. Same-store sales growth at 11% was also positive, so management commentary on the future outlook will be more important. For Dish TV, however, both the revenue as well as the EBITDA was below what the street was working with. Not just that, even if the internals, if you take a look at net subscriber additions and the average revenue per user, both of them fell quarter on quarter. Even if they had not, you know, for Dish TV, the near-term trigger will of course be the promoter level debt and the Z Entertainment deal, the impending deal, that would be the key trigger for the stock. Suven Life Sciences, Ekta says it's a poor set of numbers, 21% decline on the revenue, 31% decline on the EBITDA and 27% decline on the net profit. And finally, IDFC First, the consolidated entity, causes a massive jump in the company's gross NPA. However, on a ratio basis, it does not increase as much because the denominator has increased as much. Operating profit also lower by 2.2%. Looks like there could be a red start.
All right, a red start there. In fact, adding to the bad news is Bharat Forge and Ramkrishna Forgings because of the very weak North America truck orders that have come out. ACT Research has put out a note where they say that North America Class A truck orders for January is down by almost 70% year on year and 26% month on month. Now, why is this important? It's a sub 20,000 print that we're getting for the first time in my recent memory at least. Okay, that graph should actually flip the other way around because it's actually falling, the sales that we're seeing for Class A truck orders, and 15% of Bharat Forge's sales comes from the North America truck market. So I expect it to be a negative for both Bharat Forge and Ramkrishna Forge.
All right. And Anuj, you have the last word. What are you watching?
So I'm extending the theme yesterday. Remember yesterday we picked out CG Power for special punishment.
What a fall.
And it was a big fall. The stock fell about 13-14%, and IDBI was the other one. I think Jain Irrigation, the theme in the market is going to be about looking at companies where high promoter shareholding is pledged and there's a liquidity issue. That's the obvious theme which is playing out in the market. And I think you should look at that. In this case, 45% of the promoter shareholding is pledged, and the stock in a bear market very close to 52-week lows. 52-week low is important because there's a threshold where there's a fear of pledged shares being sold into the market. So that's why. And the other one is Ajanta Pharma. I think while there's a bit of a move on in the large cap pharma like Dr. Reddy's and Divi's Labs, the mid cap pharma is seeing a bit of a bear market move, especially stocks like Ajanta Pharma and Strides. Earlier, Granules also used to be part of this list, but Granules is no longer an F&O stock. So the naked shorting over there has stopped. But that's also another stock that you want to watch out for.
Okay, well, let's do a quick recap then of our top stocks. Stocks with positive news flow: Jubilant Foods, Tech Mahindra, HPCL, Hindalco, DLF, Brigade Enterprises and V-Mart. While stocks with negative news flow: Blue Star, Torrent Power, Tata Chemicals, Soba, Dish TV, Suven Life, IDFC First Bank, Bharat Forge, Ramkrishna Forgings, Jain Irrigation and Ajanta Pharma. But apart from the stocks in focus, there's a larger issue at hand. India Ratings has released a report on banks talking about much larger NPAs in the days to come.
I don't have entire originals of the report other than a bit of quotes, but they are saying that 2 trillion rupees, that is 2 lakh crore of more NPLs could come. Basically, they're looking at those companies which have an interest cover of about 1 or 1.5, and they're already stressed. So those, about 40% of that they expect could go into NPAs, and hence this figure. It's actually 3.5 lakh crore of bad loans that have not yet been recognized, or rather stressed loans that haven't been recognized. 40% of that could be something between 1.5 and 2 lakh crore could still reach. They are saying that it won't lead to higher provisioning, but that's difficult to believe. If it is about 2 lakh crore, then provisioning will be high, and therefore, you should expect a continued strain on the profitability of these banks. As usual, India Ratings doesn't tell you which bank because they only speak about the sector. So, you have to just take it as to the distribution will probably be more towards the weaker banks and not so much the stronger banks. They have also a word on NBFC saying that they see the liquidity crunch continuing, and especially NBFCs exposed to the realty space. But I think that the market is well discounted.
Okay, we'll try and reach out to India Ratings as well. Let's take a quick break on that note. On the other side of the break, some technical ideas coming up with Ashwini Gujral, Sudarshan Sukhani and Nitesh Thakur.